Okay, so this is going to be exercise 5.5 on page 542. And this one, actually, this exercise, we will do the buyer side and the seller side for the same problem. So you can kind of get a good comparison. Okay, so exercise 5.5 has a whole bunch of information in that paragraph, and I'll just read it real quickly because we're going to have to go back to it and break it down. On June 10th, Pius Company purchased $9,000 of merchandise from MacGyver Company on account terms 3/10, N30. Pius pays the freight cost of $400 on June 11th. Goods totaling $600 are returned to MacGyver for credit on June 12th. On June 19th, Pius Company pays MacGyver Company in full, less the purchase discount. Both companies use perpetual inventory system. So A is prepare separate entries for each transaction on the books of Pius Company. So we're going to do Pius Company first. And if we look at it, we know that Pius Company is the buyer because it says Pius Company purchased. Okay, Pius Company purchased. So hold on. Okay, we know Pius is the buyer. So we are going to go ahead and go through the transaction or go through the paragraph one by one and do each piece as we come up to it. Okay. So on June 10th, Pius Company purchased $9,000 of merchandise from MacGyver Company on account terms 3% 10 net 30. All right. So we're Pius Company. We're the buyer. What do we get? We got inventory, right? So the date is June 10th. We're going to debit inventory. And we're debiting inventory for $9,000. Okay. And then we are going to credit accounts payable. We're going to pay it at a later date, and we know that because they listed terms. They listed terms, so that tells us we're going to be paying it at a later date, which is $9,000. Okay, June 10th. All right, so now the next line in the paragraph says, Pius pays the freight cost of $400 on June 11th. Okay, so we know that when we're the buyer, everything goes to inventory, right? Put that in the wrong spot. Next line down. Everything goes to inventory when you're the buyer. So we're going to be debiting inventory for the cost of the freight, which is $400. And then we're going to be crediting cash because it says paid, and we're the ones that are paying, so our cash is going down. Okay. All right, we go back to the paragraph and it says goods totaling $600 are returned to MacGyver for credit on June 12th. So we as the buyer are returning goods. So when we're returning goods, we need our accounts payable to go down and our inventory to go down. So that means we have to do the opposite of the regular balance. So we have June 12th. We're going to be debiting accounts payable to make that go down because we're no longer going to owe that money. And so that's going to be a $600 debit. And then we're going to be crediting inventory because when you're the buyer, everything goes to inventory, right? And this is if it's a return or an allowance, it goes back to inventory. So that entry right there would be a return or an allowance as the buyer. All right, so then we read on in the problem, and it says, on June 19th, Pius Company pays MacGyver Company in full, less the purchase discount. All right, so less the purchase discount. So we have to go through and do the formula to figure out the dollar amounts. And so when you're the buyer, the formula is purchases minus any returns or allowances gives you the accounts payable number. The accounts payable number times the discount percentage gives you the discount dollar amount. The accounts payable number minus the discount dollar amount gives you the cash amount, okay, that you have to pay. All right, so let's do this. Purchases. Our purchases are $9,000 minus any returns or allowances. Well, we had a return of $600. So $9,000 minus $600 tells us that our accounts payable number is going to be $8,400. That's how much we have to pay. But we get to pay less because we get to take a discount because we're paying early. So we take that $8,400, our accounts payable number, and we multiply it by the discount percentage, which is 3%. So 8,400 times 3% is $252. So we get to take a $252 discount. So we're going to take that accounts payable number of $8,400, $8,400 minus the discount dollar amount of $252 is going to give us the cash amount that we have to pay, which is $8,148. Okay, so now we have all of our numbers that we need. So as the buyer, we are going to, let me put the date, June 19th. We are going to be debiting accounts payable because we want that to go down because we're paying off the bill. So we're debiting accounts payable. And how much are we debiting it for? Well, we already figured it out. It's $8,400. Purchases minus returns and allowances, right? So we're going to debit accounts payable, $8,400. We are then going to credit inventory for the dollar amount of the discount, okay? The dollar amount of the discount is $252. And then we are going to credit cash for the amount that we're paying, and that's for the $8,148. So that's the amount that is being paid. Okay, so we're going to do part B here. So the same exercise 5.5, page 542, but we're doing part B. And part B says, prepare separate entries for each transaction for MacGyver Company. The merchandise purchased for Pius on June 10th cost MacGyver $5,000, and the return goods cost MacGyver $310. So you're doing all the same entries. You're just doing it from the perspective of the seller now. Okay, so we're going to go back and we're going to read each one of the entries, but we're looking from the seller perspective. So on June 10th, Pius Company purchased $9,000 of merchandise from MacGyver Company on account, terms 3%, 10, net 30. So we made a sale to Pius Company for $9,000. And then if we go back down to B, it tells us that the merchandise purchased by Pius on June 10th cost MacGyver $5,000. So we knew that for the second part of the entry. Okay, so the date is June 10th. Right? And we are first going to be debiting accounts receivable for the amount that we are selling selling the items to the customer for. And so that was for $9,000. Okay. Right. And then we are going to be crediting sales revenue, $9,000. That's the first part of the entry. That's for the amount that we sold it for. But now we have to do the entry for the cost of goods sold and the inventory. So they told us we're going to debit the cost of goods sold. So we're debiting the cost of goods sold for the amount those goods cost, and they told us it was $5,000. And then we're going to credit inventory, $5,000, because we're taking it out of our inventory. Okay. Then we go down to the next part, and it says Pius pays freight cost of $400 on June 11th. Okay, we're the seller. We don't care about that. We don't do anything with that because we're the seller and the buyer paid the freight. So then we go to the next one. Goods totaling $600 are returned to MacGyver for credit on June 12th. And if we go down and look at part B, it tells us that the goods returned cost MacGyver $310. So we need both of that because remember, it is a return. If it's an allowance, you only have one part of the entry, but if it's a return, there's two parts to the entry that you have to do, okay? All right, so let's see. The date is June 12th. Oh, wait. I just remembered something. Okay. Because we are the buyer and not the seller, we actually have to put the words no entry. We have to put the words no entry in there. That's why I have a box here. So June 11th as the buyer, there's a no entry on this because that would be something that only the seller would do an entry for. In the real world, you would do nothing with it. But remember, this is the last time we'll see this. we don't do an entry for this. And you would know when you're doing your problem because you would have an extra set of lines there that you would be like, what am I supposed to put there? And that would be, or the freight that the buyer paid for and you're doing the seller side. Okay. All right. So now we're going to go on to the next date, which would be, oops, hold on. Putting boxes in the wrong place here. Okay. Now we're going to go on to the next date, which is goods totaling $600 are returned to MacGyver on June 12th. Okay, so the date is June 12th. And first we're going to debit sales, returns, and allowances. So we're debiting sales and returns and allowances for the amount of credit we're giving the customer, which is $600. And then we're going to credit accounts receivable. Because we're no longer going to be receiving that money. Then we need to do the second part, which is getting the stuff back into our inventory. So we're going to debit inventory. And we're debiting inventory for the cost of the goods, and they told us that was $310. And then we're crediting cost of goods sold because we want to reduce cost of goods sold because the item's no longer sold. It's back in inventory. Okay. All right. If it was an allowance, we would only be doing the top part, which is the portion of what the customer would be getting credit for. Okay. All right. Now, the last part says, on June 19th, Pius Company pays MacGyver in full less the purchase discount. Both companies use perpetual inventory system. Okay. We actually already know what the numbers are because we figured all the numbers out up above here, but we're going to do it from the seller's perspective just so you know kind of the terms, okay? So it's sales minus returns or allowances gives us the accounts receivable number. Accounts receivable number times the discount percentage gives us the discount dollar amount. And then the accounts receivable number minus the discount dollar amount gives us the cash amount. So the sales were $9,000 minus any returns or allowances. So we had a return of $600. $600. So that gives us an accounts receivable number of $8,400. Okay. We're then going to take the $8,400. We're going to multiply it by the discount percentage. And for this problem, it was 3%. So 8,400 times 3% gives us a $252 discount. Same numbers as before, but just different titles in the formula, right? We're then going to take the accounts receivable number of $8,400, and we're going to subtract the $252 discount dollar amount, and that's going to give us the cash amount that we are going to be paid from the customer, $8,148. So, as the seller, let's put the date, June 19th. As the seller, we're being paid. So what are we getting? We're getting cash. And the cash amount that we're getting is $8,148. Okay. We're then going to debit sales discounts. And we're debiting the sales discounts for the amount, the dollar amount of the discount, which was $252. Okay. And then we're going to be crediting accounts receivable for the accounts receivable dollar amount, which is $8,400. And that is to clear out the customer's account to show that they paid us off. So that would be the entries from the seller's side for that problem.